Hi, I'm Geoff Marcus from AlphaMaven. Today, I'm going to be interviewing Charlie McGurraugh, who serves as both the CIO of Altis Partners and as the Chief Strategy Officer for blockchain.com. Charlie, you're uniquely positioned to talk about the convergence between traditional markets and new markets in crypto. Could you briefly give an overview of your background and how you view the role of a modern trader?
Sure. I grew up on trading floors in a traditional investment bank. I spent 16 years as a trader at Goldman Sachs across credit, mortgages, and commodities. And so I've seen quite a lot in micro and macro fixed income world. And then since 2016, I've been working in tech startup world, first and electronic trading, first in sports betting and then in cryptocurrency. And it's all kind of the same thing, which is basically how do we manage risk better with software, and trading liquid markets in crypto. It's sort of like you have levered things. It looks a little bit like foreign exchange or a commodity, and then of course in futures, it is foreign exchange and commodities and equity indices and so forth. And so it all comes down to the same principles of basically risk management, risk premia, risk factors, and managing your bankroll effectively in liquid markets. A big piece of it is actually exercising thoughtfully the option to be flat, not just always having a bet on, and that's a really big part of it.
Thanks, Charlie. What are some of the biggest market opportunities you're seeing in crypto and liquid alts currently?
Yeah, so I think it's a really interesting market environment because the long-term asset inflation that has really powered forward markets with a couple of notable blips, namely SEP 11, the dot-com crisis, the taper tantrum, the global financial crisis. There's a few of these blips along the way, but basically you've had a 40-year bull trend in bonds, which has powered a bull trend in all financial assets, right? And additional policy with moral hazard and so forth. We're at the end of that long-term low inflation, excess savings cycle, and rates are going to be higher or at least more volatile, both in real terms and in terms of inflation and nominals, right? So all three kind of dimensions, like inflation, nominals, and the difference between them. That means that as an allocator of capital, being focused on just holding financial assets while they reflate more is not really going to work, I strongly believe. And that means that you need to be in the risk moving business, not just the risk storage business, because just having something sitting around doesn't mean it's necessarily going to keep appreciating. So in a world where valuations are more dynamic and less trending over the extreme long haul, buy and hold may be less advantageous, right? Therefore, you want product that can be short, you want product that can be nimble, and you want product that is benefiting from other kinds of risk premia other than just financial asset reflation. You need multiple risk premia, and you need to be able to weight between them dynamically and liquidly. And so our systems are really focused on multi-asset risk premia, multiple dimensions of risk premia, and then trading liquidly in the world's most liquid markets, which are regulated futures, to capitalize on changes in them through time.
Thanks, Charlie. I appreciate the insights. Now, Altis recently launched a new global macro strategy, which is live on the platform. CTAs are the best performing asset class this year. Why are they so well suited for this environment, and how long do you think it will continue?
Yeah, it's a great question. So most CTAs benefit from primarily one risk premium, which is trend, right? And trends are, of course, super interesting because they are the process by which markets ingest information and find new price points. And they're hard to arbitrage away because they happen on different wavelengths. Like, of course, if news hits, all the day traders react, but then, they only have so much balance sheet to push the price one direction or the next. And, over time, investment committees reallocate, cross-sectoral movements happen and so forth. So think of trend as like multiple wavelengths of how does a market ingest information, right? But there's, and for the last, really since QE kicked off in 2008, it's been pretty hard for medium wavelength trend followers to make money because the Fed anesthetized the market by just providing free money, which meant price discovery didn't happen as much because if the job of a trend follower is to take the price where it's predicted it could go by providing your capital, the Fed just provided all that capital cheaper, way cheaper, right? So it didn't work as a risk premium very well for the last, quite some time. Now that that liquidity is being removed from the system, the chance to charge capital, to where the variance of discovering new prices is basically much higher, the pricing power for that, and that's likely to persist as long as QE is being rolled back. On top of that, there are other kinds of risk premium in the market away from just trend, things like valuation, and intermarket lead lag relationships. And in an environment that is highly, highly uncertain, right, different classes of participants in the market are going to react at different times, right? And in different degrees of severity, non-contemporaneously. And that means that the relationships between these things can get quite out of whack for quite some time. And so the more structural volatility there is in the market, the greater the opportunity to commit your capital to provide liquidity to bridge between these things when they're statistically predictable. And because we are likely in an environment of high structural volatility, right, with the resurgence of inflation volatility, with far more uncertain policy pathways, not just in terms of monetary and fiscal policy, but also ultimately in terms of social engineering, a war on inequality, redistribution, tax, and all that, technological change, all these things are creating a higher degree of flux in the system than we have experienced recently, and that allows for sort of cross-asset relationships to get a lot more out of line. So the combination of trend, value, and lead lag should be a very profitable thing to provide liquidity for the foreseeable future.
Charlie, thank you so much. I appreciate your insights. Thank you so much for joining us today, and we hope to have you back again soon.
Thanks again. I really appreciate the opportunity to connect today.